Yo, hello everyone and welcome back to Dividend Investor. I'm back today with another video in my series Dividend Stock Analysis. And in today's video I'll be going over the Colgate stock, ticker symbol CL stock. Just obviously basically going over a bit of information about the company, obviously a bit into the financial health of the company. But obviously the main focus of the video will be going over that dividend yield score out of 6 on the Simply Wall Street app. So obviously if you're new here guys and you're not subscribed or you're not seen any content before, obviously I talk about investing, personal finance and stuff like that, different stocks. Definitely consider subscribing if you're not on a goal to get to 1,500 subscribers, so I need all the help I can get to get there. And obviously at the end of this video, if you like what you see, give it a thumbs up, help me boost the algorithm out and get this video and channel out to more people. Also feel free to leave a comment as well guys. So that's it for the introduction. So I'll now get into the context of the video. So the Colgate stock, just going to a bit, as you can see there, just going to a bit of key information about the company. Name Colgate palmolive. I can't even know how I say that properly, but anyway. Ticker symbol CL on the New York Stock Exchange, founded back in 1806. Really long tail company, been around for lots of years. I think they are actually a dividend king. I think that is the correct, yeah. Industry, household products, obviously toothpaste is a major one, obviously everyone knows, everyone obviously uses, it's not going to be going away anytime soon. It's in the household sector with a market cap of 63.049 billion, outstanding shares of 856.3 million, 53 million. Obviously if you want to look at a bit more about the company and products, you can see there, they've linked the websites, obviously www.colgatepalmolive.com. So yeah, that is the first part of the video guys, information. You can see they're pretty basic, just a bit of obviously basic information. Now I'll get into a bit more nitty gritty stuff. We'll go across to the health of the company. Obviously Colgate's financial health, they get a 2 out of 6 score. As you can see, short term they have assets of 4.25 billion. I'll explain what assets and liabilities are a bit further down in the video. And the liabilities, obviously the liabilities are quite high at the moment, higher than the assets. But long term, the assets of 10.82 billion do outweigh the liabilities of 10.29 billion. So you can see the short term assets do not cover the liabilities. So short term assets are assets owned by the company in which can be sold, converted to cash, or liquidated within 1 year. So it could be anything as I don't know, maybe shares in a company or certain products, machinery, anything that's in the company that can be sold. And short-term liabilities, which are commitments the company has made which are due in 1 year, so it could be anything as loans or just basically loans or anything that they need to pay for within a year, any products they might buy or not pay for straight away, etc. So again, long-term Colgate short-term assets do not cover its long-term liabilities, obviously again stuff that needs to be paid, but it's not too concerned if the short-term assets can't pay the long-term liabilities. So next, it's Colgate's debt to equity ratio. So explain a bit what that is. Debt to equity ratio, it measures how much a company is financing its operations through debt versus wholly owned funds. The higher the ratio, the more debt the company uses to fund its operations. So that's basically could be using a lot of loans to buy certain things that I'm not too sure, maybe machinery they need or money to sort of fund the company. So it's a really high number, 2,108.5% considered high. This Colgate's debt to equity ratio has increased from 830%, so it's obviously to as it is above in the last 5 years. They're the two. Debt coverage, Colgate's debt is covered by its operating cash flow, 45.81%. They generally look to an operating cash flow to be at least 20% of its debt. So obviously Colgate's is more than double that, so it's 45.8% of its debt. And operating cash flow is how much a company generates from its core business activities in a given period. So it's obviously good they are making a lot of money, which is obviously being able to pay off any debts. If a company generates enough cash to fund its operations, or it may require external financing, so it's good that Colgate can sort of cover their own backs, so to speak, with the business and products that they sell. Interest coverage of debt. Colgate's payments on its debt are well covered by its EBIT. If you know what EBIT is, it's earnings before interest tax. Interest payments are repayments a company has to make to bank, obviously, if they borrow money, and any interest they have on that, a bit like a mortgage, for example, you have to pay interest on that. But obviously, the interest payments on the debt are well covered. Obviously they look to at least be 5 times, but this is up 26 times. So it's good, it's a lot of money being paid in advance. So now let's check out the balance sheets. Obviously long-term assets, you can see there another assets which is 7.83 billion. Receivables 1.6 billion. Inventory 1.3 billion. Physical assets, which obviously is stuff that they probably have obviously buildings and etc. and all sorts of other products that they have inside the buildings. 3.5 billion, and cash and short-term investments, which could be dividend payments and shares of a company. 897 point not a million. Not a million. That's a bit of a strange word. So obviously they have debt 7.32 billion, but you can see 7.2 billion. Sorry, but obviously the long-term assets do cover that. Other liabilities, I think obviously debt's in red as obviously debt isn't good, but they can have liabilities which I think they're stated in green because obviously you can have bad debt, so to speak, if that makes sense. Like a mortgage is bad debt, it will, and obviously a loan could even be good debt. Just depends on how you see it. So yeah, that is a bit about the financial health there, guys. So Colgate obviously have a bit of debt, but obviously in the long run I do think they are well equipped to cope with it. So now we're into the part what we was all looking forward to, which is my favourite part of these videos. I'll be going over the dividend yield dividend yield score out of 6 using the Simply Wall Street app. So the Colgate score, it gets a 5 out of 6 dividend check, which obviously is really good. As I always say, anything over 3, 4 is really good. The dividend yield is currently 2.39%. So let's go over the checks. The dividend of 2.39% is higher than the bottom 25% of dividend pays in the US market, which average at 1.66%. The blotch on the scorecard is obviously low compared to the top 25 dividend payers, who average a 4.43% dividend yield. Again, every video I say it's not always how high the dividend yield is. It's usually the higher it goes, usually the worse it gets once you get past a certain percentage of yield. Next, dividends per share have been stable in the past 10 years. Score number 4, the payments have increased in the last 10 years, always good dividend growth stock. Dividend coverage with its reasonable payout ratio of 58.5%. The dividend payments are well covered by their earnings, so they can easily pay all the shareholders out. And score number 6, the dividends in 3 years are forecast to be well covered by their earnings with a 59.4% payout ratio. And as you can see there, guys, nice little upcoming dividend payment. So today is 19th of June, so the ex-dividend date, if you don't know what the ex-dividend date is, you must be a shareholder of the company before this date to receive the next dividends. So if you do buy if you buy a share on the 17th of July, it won't count for the dividend payment on the 14th of August. You have to buy it the day before that, or any time in this period. So you'll receive a nice little dividend of Colgate on the 14th of August if you buy a share now. So yeah, that is pretty much it for today's video, guys. Obviously, Colgate's a stock I personally own in my dividend portfolio. Great dividend stock to own. So just let me know if you own the stock, guys, and let me know what you think of it as a whole, if you're thinking of buying it, if this video has helped you. So yeah, just give me some feedback in the video, guys, in general. So, and on that note, I'm going to leave you to it today, guys. Don't forget to subscribe if you haven't, and like this video if you like it. Get in the comments, just, yeah, get the interaction going. Anyway, I'm going to leave you on that. Bye.